Okay, guys, the hottest topic out there right now at the recording of this video is the question, is a recession coming? Is that looming? Is it out in the future? Will a recession be coming down the pike here anytime, any day, any week, any month? And the reality is no one has a crystal ball, but there is some data that suggests what that may be or look like in the very near future. So that is the hot topic on the street everywhere you go for the right now, in the media, in the news outlets. So we're gonna address that with facts right now. So stay tuned, guys. Okay, guys, so what is a recession? Let's define that first. Now, by definition, that recession is 2 quarters back to back with negative GDP growth, gross domestic product, okay? That is what technically a recession is. Could it be a little bit more than that? Sure. There's some subjectivity to that when people say or talk about a recession, but that is what the definition of a recession is. Now, what are the two major things that we're going to focus on here that are potentially going to affect whether or not we go into a recession here shortly or not? Number one is the Fed plan to raise interest rates. They have obviously a big issue right now with inflation, and so that is the number one weapon at their disposal to curtail out of control or rising inflation. The second thing is a inverted yield curve. That's a very hot topic. What exactly is that? Okay, well, you have short-term debt instruments and you have long-term debt instruments. Typically, a long-term debt instrument will pay out a higher yield than a short-term debt instrument, as it most likely should. Okay, now when it inverts, you have a situation where the short-term debt instrument will actually pay out more, equal to or more, than the long-term debt instrument. Now, these are, of course, assuming that the debt instrument is of the same credit risk profile. When that happens, that typically signals that a recession is looming in the near future. Now, on March 29th, that happened, okay? The yield curve was inverted, and therefore everyone blew the horn saying, you know what, a recession is coming. And the reason why is because the vast majority of times in history when the yield curve has inverted, there has been a recession that has followed, okay? So it's just history that we're looking back at to try to help predict the future. Now, the reality is though, is it's not bulletproof, okay? This is not bulletproof because there have been a couple different instances where this happened and a recession did not follow. You had a time period in 1998 and a recession did not follow. And then of course you had a time period in 2016 where a recession did not follow. So those are a couple instances where it's not 100% bulletproof, but could there be a recession looming in the future? There very well could be, but that doesn't necessarily mean just because the yield curve inverted that it's going to take place. Again, these yields are based off of, for short term, most of the time, a 2-year treasury versus a 10-year treasury, okay? Those are the difference between a 2-year and a 10-year. Now, some economists will actually compare for the short-term yield treasury versus the long-term yield treasury. They'll compare a 3-month treasury versus the 10-year treasury, whereas obviously we just talked about some economists will do a 2-year treasury versus a 10-year treasury most of the time. But the 3-month is also a way to accurately try to predict the yield curve or the inverted yield curve. And again, when you go off the 3-month, it's even less accurate or less bulletproof, I should say, because there was 2 instances as well where this happened, and that was in 1967 and 1998, and no recession followed in either one of those time periods. Okay, now as according to this video, there is a healthy spread actually between the short-term 3-month treasury and the long-term 10-year treasury with that yield, okay? And it is not inverted. Currently, the 3-month is at 0.67% and the 10-year is at 2.60%, which is creating a spread of about 193 basis points. So that's actually pretty healthy right now with some good room in between those two yields. So what to look for? We're gonna look for 2 main things again, which are the interest rates increasing and the rise of inflation. Now, the Fed already said they're going to raise rates 7 times this year. We'll see if that happens. But if they do, what they'll do is actually put pressure on the 3-month or short-term yield upward, which then could make it more likely to have that yield curve invert and have another inversion again this year. So that's something to keep an eye on at this point. But right now, there is plenty of maneuvering to do between that spread of the short-term and long-term yield. Okay, so what does all this mean for you as a homeowner or even an investor? Well, number one, don't get caught up in all this negative news, okay? as we know, the media likes to overreact on many, many stuff. And as soon as they have one data point to run with, they'll run with it for days and weeks. And sometimes, I know it's hard to believe, blow that out of proportion, right? Not to say it's not serious, but again, just don't get caught up on only negative news. Number two, we're not going to have a repeat of what happened in the 2007, 2008 housing crash, okay? We're just not. The fundamentals of the underlying economy are completely different, and it's just not going to happen when we do actually have that upcoming recession. And number three, when we do have that recession, it's going to be mild compared to, again, our most recent one that everybody has, PTSD with, which was the 07, 08 housing crash that lingered for obviously several years. Okay, so those are three things to be on the lookout for that are good news really overall when it comes to what to look for in the future. Now, keep in mind, right now, unemployment rate is extremely low. As you know, there are millions of jobs right now in America that cannot be filled as employers continue to look for qualified candidates, okay? So with unemployment being very low, that's going to help obviously not have a recession. And number two, if you look at savings for Americans, it is at an all-time high. That's right. I know a lot of people spend a lot in America and our economy runs off of the consumer spending aspect, but right now, consumer savings have never been at a higher rate overall in the United States. So those are two really reasons as to why a recession may not be right around the corner, but actually may be several years away. Okay, now no one has a crystal ball. We don't know where it's going to go specifically, but when you look at these data points, this will help dissect what you think, ultimately making a decision with this information, what you think will happen in the near future. And is a recession really right around the corner, or potentially is it another couple years away? So guys, let us know what you think, comment below, or actually better yet, call us or email us. Let us know your opinion. I think at the end of the day, you don't want to get caught up on one data point. You need to have the whole picture and try not to work off emotion, which the media sells to an individual, and look at those points and make your decisions accordingly, whether it is investing or whether it is, just owning a house in general. Remember, your best hedge against inflation and rising interest rates is a fixed rate mortgage. So if you're gonna buy a house to live in or to buy one as an investment, you wanna get that 15, 20, or 30-year fixed rate mortgage, and you will be locked in to hedge your risk against these two main things that are happening in our economy right now that could ultimately lead us to a recession at some point in the future, which are the rising of interest rates, and of course the inflation getting a little bit out of control here pretty quick. So hopefully the Fed can do their job, and the economy will correct itself to where that inflation starts to plateau and level off, and it hopefully even decrease towards the end of 2022. But guys, we'd love to hear from you. Call us at 480-442-9868 or info@kellycookhomes.com. I would love to chat with you and discuss this further. I love getting deep on fundamentals of the economy to try to help provide value to our clients as to what may be coming down the pike in the future. Thank you very much, guys. Talk to you soon.